attending my final presentation for the capstone unit. The presentation will be on fintech and deep learning, where we try and enhance technical trading strategies with deep learning. So what did we aim to set out to do? We aim to ask whether or not deep learning can act as a decision auditor to assist our technical trading strategies. So what that means is we will have a technical trading strategy that will give us a trade signal. Then we will use deep learning to verify whether that signal is the right signal or not. And then when there is agreement between the two, then we enter into a trade, and hopefully that will mean that we're making more successful trades and making fewer poor trades. But we faced a few challenges in our study. So the first one being the nature of financial data sets, and then the second one being the suitability of our models, mainly around their complexity. So I'll explain a bit more about that in the following slides. First, motivation. So our motivation stems from the number of retail traders increasing dramatically since COVID. So retail traders or retail day traders are not your institutional traders, but your everyday people. Not many of them are profitable. So actually very few are profitable. And generally they use technical trading strategies, but obviously there's a problem with them if not a lot of them are profitable. And so we asked, can we introduce deep learning to help improve the trading strategies? Bit of a literature review. So starting with technical models, what are they? So technical models are based on technical indicators, which are usually based on price, and they look to follow trends. So a very, I guess, simple and toy example might be that if we see the price of a stock increase every day for the last 5 days, then we might expect it to increase again on the 6th day. They've been widely used since the 1980s, so a lot of people have been using them for a long time. But one of their biggest flaws is that they are hard to generalize. So what that means is we might be able to find a strategy that is very good when we're backtesting, but when we actually put it into practice, it might not show the same results. Now, deep learning is a little bit more modern than the technical indicators. And in recent years, deep learning has really excelled in very complex tasks like computer vision, speech recognition, or even generative AI. And there has been some success with stock price prediction as well from other literature. And then financial data. So financial data is very different to a lot of those fields where deep learning has traditionally excelled at. So for example, the first one is a small data problem. And let me give you an example to describe that. So imagine we are trying to predict the next day's close price, the direction of the next day's price. It could be up or down. So over a given year, we would have 365 data points. Now, literature from other fields, especially medical imaging fields, suggests that you need thousands of samples to get an accuracy of a high accuracy. So I think in one study it was above 99%. But we can see that even if we have a year's data for the close price, we'd only have 365 sample points just for 2 classes. And then the second problem is the low signal to noise idea. So what that means is, again, another example, imagine if we have a classical classification problem of classifying cats and dogs. Well, you train your model on cats and dogs, and then after you get a good model, then you start the inference, then you can easily identify cats or dogs. Right, so it's pretty simple, but financial data isn't like that. You will train your model, but then once it comes to inference, theory states that if there is a signal that is exploitable, then this will gradually be reflected in the prices until it's no longer exploitable. So theoretically, it's kind of akin to cats morphing into dogs over time. The research question, what did we seek to answer? So we first built technical indicator models to give us that signal. Then we passed it over to a deep neural network to tell us if it agreed or disagreed with the signal. And if there is agreement, then we make the trade. If there is no agreement, then we don't make the trade. And hopefully by doing this, we don't make poor trades. So end-to-end methodology. First, we acquired tick-level data from Dukascopy, which is a Swiss online bank. Then we built the technical indicator strategies using MetaTrader 5. We exported the backtested data from MetaTrader 5 and cleaned it and prepared it. So did a bit of feature engineering for our deep learning models, which we built and trained using PyTorch. And then we evaluated against classical data science statistics and financial metrics as well. So the technical strategies were based on the following technical indicators. So Williams percent R, RSI, SMA, Keltner, Maroon, Donchain, and EMA. So these are just really common technical indicators. And our deep learning models were, again, based on very common models. So we got the MLP, CNN, LSTM, CNN, LSTM, and then we also tried LSTM attention. When we trained our deep learning models, we also used a weighted cross entropy loss. And this was to try and deal with the imbalanced nature of our data set. So the imbalanced nature of our data set came from our technical strategies, recommending a hold position for the majority of the time. To evaluate success, we first looked at classic data science metrics for classification, so F1 accuracy, precision, recall. But then we also looked at financial metrics, so Sharpe ratio, drawdown, profit. Arguably, the financial metrics might be what retail traders are more interested in because it tells them how much risk they're taking and what profit in return they will get. So data collection and cleaning. Again, we sourced our data from Dukascopy at a tick level. Then we passed that into MetaTrader 5, where we built our technical indicator models, and we backtested using MetaTrader 5. Then we exported that to a raw file and processed that in Python. So that export from MetaTrader 5 is a 2D array. So each row would represent a time period and each column would represent a feature. What we did to process it was we turned it into a 3D array where the third axis, the Z-axis, is now a time series feature. So each row would have its history in that third axis. And then we applied row-wise normalization. So using the min-max scalar. So normally the min-max scalar is applied to the whole training set. However, we don't do that. We apply it to the row level because the nature of financial data is that it always moves up, or generally moves up. So if you think of, say, the ASX 200, maybe 20 years ago versus now, the nominal value will be much higher now than 20 years ago. And so if you apply min-max scaling to 20 years ago, and then you transform today's data, then most likely you will always see the max, so you wouldn't see the variation, which is why we use the row level normalization instead. Our third transformation is in experiments 2 and 3, which I'll explain a bit later. We concatenated a few different assets together. So what that means is we ran this process for a few different assets. So firstly, Euro USD, US, then we did it for US 100 and UK 500, and we combined that data together to form I guess a super data set to see if we can learn from different assets and if there is some I guess correlation between them. Implementation. So we use MetaTrader 5 as our building block to get the technical trading strategies. Then we cleaned and featured and engineered using Python from the outputs of MetaTrader 5. And we use PyTorch for the deep learning, and all the software packages and versions are listed on the left-hand side. Results. So experiment number one was conducted on the Euro-USD Forex pair using the 1 hour candle and all of our technical indicator strategies with a fixed TPSL. So beginning on the right-hand side, we can see the data science metrics, and they're all kind of very low except for the hold value, and this is purely because of the nature of the imbalanced data set. So you can see that the support value for hold is about 4,500, but then for buy it's about 53. So very, very imbalanced. On the left-hand side, we show the financial metrics. Now, the financial metrics are calculated when both the deep learning and the technical indicator strategies agree. And we can see that on the first line, so technical strategies without deep learning outperformed all of the deep learning models combined with the technical strategy. And so we didn't really see any benefit of the deep learning here. But in terms of the best of the rest, then LSTM attention was the best of the deep learning models. Experiment number 2. So this one, we combined the Euro-USD, US 500 and UK 100 datasets together. We used a 5-minute candle as well to try and increase our sample size for the buy-sell classes. We only looked at the EMA this time, and we used a TPSL based on EMA as well. So the reason why we use a TPSL based on EMA and not a fixed TPSL is because the denomination of Euro-USD is in the dollars, so dollar maybe be $1.50, $1.63, whereas UK 100 and US 5,000, they're in the thousands. So therefore you need a relative TPSL. Again, the data science metrics, not that interesting. They're all very low due to the imbalanced nature. So interestingly enough though, the LSTM attention model was the best performing model, but the caveat was that none of them, the models were profitable. So it didn't really help our profitability at all. And then on to experiment number 3. So what we tried to understand with experiment number 3 was whether or not combining the data sets was worthwhile. So did it improve our classification? Did it improve our performance? So what we ran was we ran the LSTM attention model in 2 instances. The first instance only trained on the Euro-USD, and the second instance trained on all 3 of those Euro-USD, UK 100, and US 500 datasets. And then when we look at the data science metrics, although they're all very small, the one trained on the combined datasets was marginally more performant. But on the financial metrics, it was a bit more of a mixed bag, where the combined dataset did have a smaller loss, but it also had a higher Sharpe ratio, so it means more risk. So into our discussion, so really classification results were hampered by a large imbalanced data set, but this wasn't reflected in the financial metrics because it's also when the technical and deep learning models agreed to each other. Deep learning, unfortunately, didn't add any profitable results or add value, I guess, to our technical trade strategies. The results might suggest that higher complexity models could perform better than lower complexity models. Yeah, and then there is also some suggestion that there is a benefit to concatenating different assets. Limitations in future work. So one limitation obviously was that we only use price data. So all of our indicators are based on price. So I guess that asks the question, does that mean price data holds all the information that we need to predict the future price? Maybe there is potential to add exogenous variables. Our overall model complexity was quite low. We did try to adapt EfficientNet v2 small in our training, but on our hardware, it took over 24 hours just to run one experiment. So it was difficult. In the future, if we did have a good model, then we would need to focus on integration to MT5, probably through the ONX framework, but also recreate the functions for data cleaning and feature engineering. And then another limitation was that experiments 2 and 3 was based on a pool-based strategy. So we found it very difficult to find a profitable technical indicator strategy based on the 5-minute candle. Yeah, so conclusion, overall, we didn't have any evidence to suggest that deep learning as an auditor for our technical indicator strategies is a viable solution. Limited evidence suggests that more complex models would perform better, and also limited evidence to suggest that combining the different assets will also be a helpful addition. And that's all. Any questions?